Good afternoon, everyone. Welcome to another one of our Wednesday market streams. My name is Stock Darts, and if you like what you see here today, you can always follow me at Stock Darts on Twitter or find me on YouTube at Stock Darts, or you could visit me at patreon.com/StockDarts, where I post weekly blog content. Typically, if you're looking for extra content from me, the best place to look is Patreon. I usually post a couple of ideas a week, giving you ideas on what I'm adding to my watch list or what types of trades I'm looking at for the week. And so during these Wednesday market streams, if you see something and you're trying to understand what kind of trades I'm talking about, usually we analyze the markets here and I try to figure out what type of price environment we're in so that I can figure out what types of trades are going to work. And usually, if you want more examples of those types of trades, you can follow me or visit me at patreon.com/StockDarts, where you'll see a little bit more thorough analysis and a little bit more thorough description of what types of trades I look for from week to week. Other than that, let's go ahead and get started. We're going to do what we always do on Wednesdays. We're going to go ahead and take a look at the four major markets. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we look through those four, we'll take a quick look at the US dollar. We'll see how gold, silver, and oil are reacting according to what the dollar is doing, and then from there we'll move on to the chart requests. If anyone in here has a chart request, you can always type it in the chat, and as soon as I cover the four markets, we'll go ahead and take a look at them. It helps sometimes if you let me know if it's a name that you already bought or if it's something you were looking to buy. Sometimes the advice could be different based on what your actual position is on the name. It doesn't even have to be a stock that you own or you want to buy. It could just be if you have a question about a certain pattern, you can always put that as well. Just let me know what you are looking for in specific with that ticker, and we'll go ahead and dive in and see what we can figure out. But let's go ahead and get started. What we're going to do first is take a look at the S&P 500 with the ETF SPY. As you can see, the markets have been doing pretty well this week. I expected us to kind of rally. For those of you that were here last week, you'll know that we were anticipating what was probably going to be another leg up in our rally. The market has broken out in a pretty strong way since last November or so. And again, for those of you that are regulars and have been here, you'll know we were expecting this. This is something we expected since the middle of last year. We were looking forward to a Christmas rally. We were looking forward to a rally in the holidays that might extend the market. And that's what we're getting so far. And to tell you the truth, I don't really know that we're seeing an end to it anytime soon. Now, the one thing that can maybe put a little thorn in our side as far as being bulls is concerned is the fact that we are now in a new earnings season. And depending on the flavor of earnings season, it can impact the markets. Now, I don't expect a major impact right now. But as we move forward, especially over the next 2 or 3 weeks, if we have a slew of bad reports, if you have a lot of names reporting, particularly if they're lowering guidance, then maybe it'll lead to sort of a pullback in the market. But even if we get a pullback in the market at the moment, I'm not that worried about it. I think that we're in a very strong market, and I think we're in very good shape. And as we go through today, you'll see exactly what I'm talking about and why I'm not that worried about the market. But do keep in mind that it is earnings season. We had a few banks report earnings today and some mixed results, but the key thing to keep in mind is if you're a swing trader and it's earnings season, is make sure you know what the report date is for whatever stocks you are looking to trade or whatever stocks you are actually holding. Because if you get caught holding a stock during the earnings report and you weren't anticipating that kind of volatility, it could put you in a bad spot. Now, yes, of course, the name can always surprise to the upside and you get a little extra boon, but as a trader, your job is to kind of limit your risk and understand and manage that. I think that's the really key thing and the most important factor to consider when you're trading is managing and trying to control what kind of risk you are exposing yourself to in the market. And so, if you don't understand what kind of risks are associated with earnings, then you're better off avoiding them. Now, those of you that know me and know me for a while, you know that I actually look forward to earnings season because I like to trade during earnings. However, I do so within a structure using options that limits my overall risk and has complete control over how much capital I have exposed during an earnings event. Because the truth is that they can be pretty unpredictable as far as the direction that they move and the volatility. But I have found a few different ways to take advantage of what is somewhat predictable options behavior. Options tend to get a little bit inflated during earnings season and then lose that volatility after the event is done and there's no more uncertainty because the numbers are out, and there's no more confusion as to what the report's going to say, because of course the report has already come out. And because of that, the options have a certain way of behaving, and I found a good way of analyzing them that helps me get us a little bit of an edge as to how they're going to behave during earnings season. I'm not saying I hit all my trades, but I found a way that gives me maybe 60, 2/3 chance of success, so about 66%, and it's worked well for me. However, I don't swing trade during earnings season if a name has a report. So if I'm, for those of you that follow me on Patreon, you know that I randomly put names that I like, and they're swing trades, looking for a directional move. And if that's the case, I always put the earnings date, that is, if it's coming up, and I basically close my trades prior to that, because the earnings move was not something that I planned as part of my trade. And if you're trading in a directional manner and you're looking for a swing trade, so for instance, last week, for those of you that may not know, we had very good trades on a couple of food names, BYND being one that was a massive move for us. This is the kind of trade that I'll take as a swing trade, but as you can see, earnings are coming up in 20 days. If we were closer to earnings, I would have closed out the trade. I don't like to trade during earnings because there's more volatility that can come in. Now, of course, in this name, with this massive kind of volatility, it's kind of a different story, but this is volatility that we can expect because we're looking for an explosive move. And we have our stop in place, and we know exactly what we're looking for as far as a move up or a move down. But once earnings comes, I'm going to get out of this trade regardless, because I don't want the extra volatility that comes in, particularly the unpredictability of a directional move. And so that's important to keep in mind, again, if you are a trader, is making sure that you understand what names are reporting and being careful about them. So for instance, Netflix reports pretty soon. You can see Netflix reports in 6 days, right? So they're reporting next week. If you are swing trading Netflix, this is not a good time to try to stick around, because Netflix is the kind of name that has fluctuations of 10 to 20, 25% during their earnings event. And it could be up, it could be down. And if you're not structuring your play in a way where you can absorb a 20% loss, then you are going to put yourself in a position to take a much bigger loss than expected. Now, not to say that you should always close out your trade prior to earnings. If this is a name that you've been holding for years and it's a long-term investment that you like, well then of course you're going to kind of hold through earnings. But there's still ways to protect yourself, whether you buy puts or put spreads, or find ways of protecting yourself, or replace with options during earnings. There are different ways to protect yourself, even if it's a name that you want to hold longer term. But the key thing is, keep in mind that we are going to see a lot of names reporting earnings, and you should keep track of what the report dates are, and make sure you understand what kind of exposure you are putting yourself into with each name. All right, now with that out of the way, let's go ahead and take a look at the stock market again. Hi Ray, good to see you in here. Good to see the other two that are in here as well. I don't see your names, but I know that there's a few people in here. I'm glad to see you guys in here, and hopefully we get some value out of today. Now, like I said, the stock market is doing very well. And what I wanted to go into before we move forward is taking a look at the longer term chart, right? Because again, like I said, we're in earnings season, and there's a chance that the market maybe pulls back if there's a lot of bad reports. But as you can see on the weekly chart, even if we pull back, we're in a good spot overall in the market. There's a lot of room to pull back, and the market still would have broken out from the base that it sort of formed over the last 2 years. If you take a look at what the market did from 2018 through the end of 2019, so basically 2 years, it basically traded sideways, ranging back and forth from about 255 to about 295. Now, yeah, there's a little bit of a dip below there, and there's a little bit of a move above it at certain points. But for the most part, it traded basically between 255 and 295. So about a 40-point spread, going back and forth, and then late last year, we finally had the breakout. And once we started to see this breakout, that's when we started to change our analysis of the market and start looking at a potential rally into the close of the year and what we could expect if we did get that rally. We finally got that rally, and as you can see, we're in a pretty strong leg up on the market now. I think that this has the potential to continue much longer, right? So those of you that are regulars know, I've pointed this out quite a few times. If you take a look at the last time we had a scenario like that, it was the end of 2016, beginning of 2017. We had the same thing. We had a market that stayed sideways for about 2 years, and then eventually it broke above that base, spent a little bit of time holding above it, proving the breakout, and then bam, off to the races. And we're off to the races for almost actually more than an entire year, right? And we did the same thing again. We had a base. We started breaking out above it. We spent some time establishing that the price action was ready to move on. And then, boom, it was off to the races. Again, this is a repeatable pattern. This is something that's happened more than once. Take a look at what happened back in 2012, 2013. We had that strong rally. It's the same sort of thing. The market spent some time sideways, eventually broke out, established price action above it, and then, boom, was off to the races. So, despite the fact that I think a lot of traders think that maybe we're overextended and that this market is ready for a pullback, the truth is that this can extend and continue a little bit longer than we would expect. And until I see something change, I'm going to assume that we're in a strong market again that's going to continue climbing throughout the year. Now, does that mean it will? No, it could pull back, of course. But like I said last week, and like I'll say again this week, we have levels that we can put into in our charts that we can look at that will give us an idea of whether this market is continuing to climb higher or whether it's going to give us a rollover or a pullback, right? So what we can do is we just watch, right? And as we have certain points violated on the chart, we'll change our assessment of exactly where we stand and what we are looking for. So first up, as of right now, the market is trending pretty steadily. I don't want to put a channel like this because the truth of the matter is that right now there aren't any points to connect to make this a proper channel, right? But I just wanted to go ahead and show you that we are, for the most part, just in a steady incline, moving higher. And really, we're just following the moving averages. That's why we don't really need that trend line in the bottom. I just wanted to give you the overall trajectory of the market. So the first warning sign is if we start to violate these moving averages. The 20, at some point, mathematically speaking, we're going to break through the moving averages, whether it's from price moving back and reverting to the mean, or whether it's the moving averages catching up to price just based off of the way they work. The 20 period will be the first one for us to test. As long as we hold up really above the 50, we're in a very strong market that's moving steadily upwards, right? However, in the short term, as long as we're holding above the 20, you know that the market is just basically ripping upwards, and we should continue to look at it as a market that we want to take advantage of trades to the long side. Now, does that mean buy the S&P 500 right now? No. You don't want to buy SPY right now. This is not a good trade. This is not what I'm explaining as far as what I would like to look at. Once we cover the four markets, I'll show you guys how I'm trading and what I'm looking at. But no, right now, if you're looking at trading, you don't want to trade charts that are mimicking the market, right? You don't want to trade the S&P 500 right now. You don't want to trade the Qs because the risk reward here is very poor. And that's really the biggest issue right now, and that's going to be the biggest issue probably throughout the year, is trying to remain disciplined and not chasing the price action in this kind of market. There are two pitfalls that traders get into when we trade in a market like this, and one of them is chasing the price action higher, and the other is trying to get cute and trying to call a top and trying to short the market. Of the two, believe it or not, the more dangerous one is chasing the price action higher. The people that try to short this, they tend to mess up a lot, but they're expecting to probably mess up to begin with. However, the traders that hold this and try to get in long are expecting the market to just continue going higher, and they put themselves in a position where they get in at the wrong time, and then the market pulls back on them and they hold, thinking it's okay, it's going to correct, and then when the market finally hits support, that's when they capitulate and get out, and that's when the market bounces. And then they wait and they do it again. They wait for the market to get back to highs. They get caught up in the frenzy of the next move, and they get in at highs again, and then they do the same thing over and over, and they're absorbing much bigger losses than the person that shorts. Now, I'm not saying the person that shorts is doing something good. They're doing something wrong as well, but of the two, the more insidious fear, the more insidious mistake to make is to keep chasing the price action. What we want to do in these situations is look for the best risk-reward possibilities we have, and understand that even though the indices are moving upwards, there are a lot of names underneath the surface that have either moved ahead of the market or moving behind the market, and are giving us better opportunities based off of where they stand compared to what the markets are doing. A lot of times when you have a market that's this strong, um, to elaborate a little bit, is you'll have sectors of the market or areas of the market that are rotating back and forth, and some of them assume the mantle of leadership and get strong, and others who were maybe who were maybe the leaders before start to consolidate and pull back ahead of the market, and the market continues upwards because other names go ahead and start ramping upwards. And so as traders, what you want to do is figure out where that strength is coming and leaving, and take advantage of it, and make sure that you are buying names that are giving you good risk reward opportunities, and then taking profits on them as they become extended and start to reach points where they're are probably going to pull back. And so that's what we want to do in this type of market. When you have a market this strong, you can play momentum. Momentum is often a good way of playing. So playing bull flags or playing stocks that are pulling back off of highs is a good way to go ahead and approach something like this. And a lot of times the easiest thing to do is just take a look at stocks making 52-week highs, put them on your watch list, and then just wait for them to pull back, and then buy them as they pull back into support. And then just keep rinsing and repeating, and you'll do well in this kind of market. It will, if this market is anything like what we saw in 2017 or what we saw in 2012 and 2013, you can easily clear double-digit returns in the year. 20, 30, 40% returns by the end of this year, just by repeating that one thing. Just buy stocks that printed highs, put them on your watch list and wait for them to pull back, and then buy them as they start to bounce again. And that's one of the easiest ways to navigate a market like this. One of the worst ways to do it is to chase the price action upwards, because you get caught up in a stock that's gone up 6-7 days in a row, and you think, well, it's not going to come down now, and then it just pulls back like it's supposed to its moving average, and you panic and get out, and then you end up taking a loss on a name that was up 10 out of 13 days, but you held it for the last 3 days. So that's one of the keys, is make sure that you understand what your trade setups are, and what your probabilities of success are. Now, like I said, the moving averages are our first warning signal, but I think with the S&P 500 right now, we've established this 320 as a good level of support. As long as the price action is above that, which it'll likely mean that we're above the 50-period moving average, we're in good shape, and we should continue to just treat this as a strong market that's running upwards. So even if we get a decent pullback, the first level of support is going to be the 20-period moving average. More likely than not, we will find support at the moving average, and we'll try to bounce off of it. If we falter and keep going down, let's say we have a really bad earnings season, 320 is the level that we want to watch. As long as we hold above 320, it means the market is going to continue trying to base out and trade sideways and establish this as the new level of support. If we lose 320, well, then that's where we have our first warning signal that maybe there's more selling pressure coming in the market, and maybe we're in line for a more substantial pullback. And if we do see that, we're going to figure out the 50-period moving average, and then from there, there's a long way to go before we get real strong support. We're likely going to find support around 314 to 313, but the next major level of support is way down here around 307, and it's not even that strong. The real key support is way down here at 302. So there is a lot of room for us to pull back and still be in a very healthy market. Do I expect us to pull back to this range? Not right now. Probably not for the rest of this month. Probably not, maybe into the middle of next month. And again, that would only be if we have some substantial selling coming in. Until then, what I'm looking at is the short-term levels. So I'm looking at the 20-period moving average, and I'm looking at 320. These are the two levels that concern me, at least from here to next week and the week after that. To tell you the truth, as of right now, I'm not even really expecting the 20-period. The way we are moving right now, there's going to be something that needs to change before I think that we're ready to pull back. I think the market's still drifting upwards, and probably the most likely scenario is, and again, you can see we're getting kind of stretched out on the S&P 500, right? We're running up into the top of this trend line. There's a much clearer trend line on the upper side of our channel than there is on the bottom of the channel, right? Usually when you have something like this, there are two things that happen. Either one, it tries to accelerate and move past it, which tends to lead towards a real rollover. So we really don't want the market to get much stronger than it is right now. The better thing that we want is for this to start to drift sideways and then start to climb back up. So maybe we get a scenario like this, where we start trading in a channel, right? And if that's the case, what we want next is we want to trade sideways and come back to the bottom of that channel, and then start to climb up and maintain price action in that. The last thing we want really is this. If we get this and we start to push towards the top of that, more likely than not, what happens next is you get something like this, right? Oops. So that's something to keep in mind. If we do start to break out past that, don't get caught up in it. More often than not, that's sort of a blow-off top, and it leads towards a much more substantial correction. Now, that's not going to mean that it's the top. It just means that we need a more substantial correction to correct the over-exuberance and the over-bullishness. And then from there, more likely than not, we establish a base and trade sideways for a bit and then maybe start climbing again. For now, I think what's more likely than not is we drift upwards or maybe sideways and then upwards again. We're seeing some strength come into IWM, which we'll get to in a little bit, and that could be the next rotation that keeps the markets moving steadily higher. Now, the S&P 500 again looks pretty. It looks pretty strong, but it looks a little overbought. It looks a little bit overextended. So there's not a lot of opportunities here, and to tell you the truth, it looks like it needs to correct. But overall, until it does correct, I'm of the opinion that we should continue to look to the long side and continue to trade names that are giving us better risk reward than this, but are still moving upwards as well. If we look at the NASDAQ, we're going to see a pretty similar picture. We're going to see a market that's just continually climbing higher. Now, the NASDAQ is, I think, giving us a little bit more clear rising wedge than it is a channel. And more often than not, this does eventually resolve in a pretty quick correction. But with the manner of this behavior and with what I'm seeing out of the overall markets, I think that we also have potential for a quick little flag and then maybe an attempted move higher. Overall, tech is really starting to improve. Now, the big thing with the Qs and with tech is that all the big names are reporting in the next couple of weeks. So obviously we have Netflix, like I said, that reports in 6 days, right? Any of you that maybe aren't aware of this, TradingView has a thing now where it shows you the next earnings report. So it's got 6 days coming up. It's that big red number here next to the name. If we go ahead and take a look, we'll look at all the FANG stocks. So we've got Facebook reporting in 2 weeks, right? So 14 days from now, Facebook will report. Apple reports again 13 days, so 2 weeks. Amazon reports in a little over 2 weeks, right? So the week after the other two. We already had Netflix. The last one is Google. Google also. And so basically, all of the FANG stocks are reporting in a 3-day period or a 3 or 4 day period from basically 2 weeks from now. So what is that? That's the 31st. So we've got this whole week here, basically from the 27th to the 31st is when all of them are going to report, right? That is going to be a pretty strong impact on the Qs, right? And that's what I would expect to be the next real. If we're trying to figure out where the Qs are going, that's probably going to be the week that really moves us in a strong direction one way or the other. Now, there's a chance, of course, that we pull back prior to that, but more likely than not, what happens is that we're gonna drift sideways and then maybe try to continue climbing upwards while we wait for those reports. Now, those reports, in 2 weeks from now, that's going to probably be the most significant week as far as earnings season, as far as what can happen with the overall markets. If we don't have any other news that comes out, I'm not sure when the next Fed meeting is, but not discounting the Fed, I think that's probably the most important. At this point, that's probably the most important thing that's affecting our market. But if we ignore the Fed for a second and figure out what's going on with the overall market, that week of earnings is probably the most important week as far as trying to understand what this earnings season, what kind of impact it's going to have on the overall markets. And I think that's going to have an impact, obviously, on the Qs, since those are all tech names. Until then, we'll see how long this wedge can continue, and we'll see whether we need to lose it or not. However, just like the S&P 500, we've got the 20-period moving average. We're well above it, so even if we do pull back, more likely than not, we're going to come back and test the 20 period, and then from there find support and try to make our way upwards. Now, if we do pull back and hit the 20, I think the more important thing isn't whether we find support. I think we will. It's what happens after that. Do we bounce back to new highs, or do we print maybe a lower high? If we do, then there's a case to be made for us to come back and test 210 to 211, which I think is the more substantial short-term support level. Now, again, even if we do come back to that, even if we lose that, there's a lot more levels underneath us that really indicate the true strength of the market. And I think as long as we hold above 195, we're still above that 2-year range that we spent, and are still in a market that is looking to clear that base and move upwards and continue the move that it's already had over the last couple of months. So I think, again, overall, we're in a very strong market, and there's a lot of room to the downside before we really change that. So I wouldn't get too caught up in short-term weakness. I'd look at it as a buying opportunity. And for those of you that are thinking, well, look, we got a rising wedge. We've got a couple of wicks up here. This looks like it needs to come down. You know, I'm not saying you're wrong. There is a chance that this market needs to pull back, but instead of shorting this, wait for it to pull back to support and then buy it. And I think that's always the difference between the way I look at something and the way a trader, a trader that maybe isn't as experienced will look at it. Is we're both anticipating, we can anticipate a drop in the market, but a trader that is not really that successful will try to short it, not understanding the pitfalls that come into that. While I will be expecting the same drop as him, but instead of trying to short it, I'll wait for that drop to come and then just buy the dip, and trade along, trade with the market, trade with the current that's going upwards, and make sure that I have as many different factors in my favor as opposed to trying to fight against them. What happens is if you try to short this, yeah, you could get a good move, but more likely than not, what's going to happen is it's going to drop for a day or two, and then bulls are going to step in and try to buy, and then they're going to make you trade a lot more difficult to really try to figure out where you're supposed to take profits. Or you could be wrong, it could move up for 3 days and then come down, and then you would have stopped out waiting for it. I find that it's much better in these scenarios to try to wait for the market to pull back to a key level and then go ahead and buy that. Now, that being said, I'm not averse to trading short. I have no problem shorting stocks, but it has to be the right environment, and we have not been in that type of environment for a while now. And it might seem like I'm a permabull because of the way that I trade or the way that I describe market, but the truth is, we're in a very strong market. We're in a market that has been propped up by the Fed for over a decade now, and it's difficult to try to short that when you're going against the stream and against all these underlying factors that are pushing the market upwards. And so what you want to do in these scenarios is take advantage of where the market wants to go and where the Fed wants to take it, where the government wants to take it, and just follow along and just take your money with it, rather than trying to outsmart everyone else and try to catch a short that may or may not work. And if it does work, it's only a quick move that you hopefully were able to time right, but it's much more difficult to time than just taking advantage of the upward bias of the market and just going ahead and going along for the ride. There's no need for us as traders. You don't need to reinvent the wheel. You just need to go ahead and follow where that wheel's turning. All right, so now, just like the S&P 500, like I said, 20-pair moving average is our first level of support. Our next level of support is 210. After that and beyond that is a 50 period. As long as we're above the 50, the market is in a strong trend upwards, and we should continue to trade momentum plays, and we should continue to buy the dips. Now, if we lose the 50 per moving average and we start to drop, then we go ahead and reevaluate where we stand. And, we'll do that at some point. There will be a Wednesday market stream where that will happen, and we'll go ahead and we'll reassess, and we'll try to figure out where the next place to go is. But until that happens, just buy the dip, continue to trade momentum upwards, and take advantage of the strong current that's driving the market forward. All right, Dow Jones. The Dow Jones is starting to move up again, looking pretty nice. Basically the same story as the other two indices we just looked at, right? You've got a nice upward trajectory. You can tell it pretty easily on the top. The bottom is not as easily defined, whether you want to call it a rising wedge, whether you want to call it a channel. It's, depending on how you want to look at this, it's still open to interpretation. But the truth is, really, it's moving along the moving averages, right? So we don't need to keep that trend line up there. Just wanted to point out that just very similar to the S&P 500 and the Nasdaq. The Dow Jones is making move upwards, and you know what? When we looked at this last week, we had seen, right. We came up, we pulled back, we had that breakout, and now we've had a continuation through the last 3 or 4 days, and we are right back to all-time highs on the Dow Jones, just like the Nasdaq and the S&P 500. It's a strong market, and everything that we're looking at tells us that it's going to keep on going upwards, and it's just up to us to not chase the price action, and just keep our wits about us, and make sure that we are trading with discipline, but taking advantage of this. Everything is said by the S&P 500 and the Qs. It goes for the Dow Jones as well. Keep an eye on the 20-period moving average as our short-term level of support. Keep an eye on 284 or 283 as our next level, and then if we lose the 50-period, then we'll try to reassess. But really, as long as we're above 274, we're above all that price action from the last couple of years, and really still in a bull market and still in a strong market. So a lot of room here for us to pull back and still look at buying dips and still look at trading to the upside. Not much else I really want to say about the Dow Jones. It's the same as the other two. The last one I want to look at is IWM. And the interesting thing here is IWM is accelerating while the other three indices are kind of slowing down a little bit. Well, the Dow Jones was accelerating a bit too, which is interesting because the S&P 500 and the Nasdaq were the two stronger ones that were leading last week. And at least as the last couple of days, the Dow Jones and IWM have been starting to creep up, which again shows a little bit of how the money rotates and how the strength rotates in this market, where IWM was kind of lagging last week. We did finally get that breakout that we were looking at as far as this little corrective channel. And look at the strength. Now, yeah, look at these wicks, right? We are finding some selling pressure. So there is a chance that the markets do need to finally stabilize here and maybe pull back or trade sideways. But IWM is gaining strength again, which is nice, right? Because it shows that traders are getting aggressive again and looking to take advantage of volatility and looking to try to get as much profits as they can, and are less fearful than maybe they normally would be. So I like what I'm seeing here. I don't like the two wicks, but that's midday. Let's see what happens by the end of the day. But overall, I like that the IWM is the one kind of leading the charge higher today. So it shows that traders are getting a little bit more aggressive and starting to try to really push the action here. Now, again, we did get a little bit of... We go ahead and look at the 5-minute. You can see that we have started to pull back a bit today. But we'll see how we close out the day. Overall, I think that the market has been pretty strong, and we've been closing days strongly, so let's see if that happens. I think that how IWM closes will be the better key as to what we can expect in the next couple of days, at least until Friday, on the stock market in general. If we close it somewhere around the middle or to the lower end, then expect a pullback and expect us to come back and test 165, maybe even come back down into the 164 area. If we close near highs, then more likely than not, we'll try to push upwards tomorrow, and then we'll trade sideways and wait for the 20 period to kind of come back up and catch up the price. And again, if IWM trades somewhere around the middle or to the lows, then expect the S&P 500 and the Nasdaq in particular to start to drift backwards and to start to maybe print new bull flags as we wait for the market to build up enough steam to continue climbing upwards. So this is the key as far as the really short-term level of strength in the market is concerned. If you want to see what the markets are doing in general, keep an eye on IWM for now. I think if we see more strength come into IWM, then there's a chance that the other markets might try to follow and try to drift upwards. But if we see us kind of roll over here and close towards the lows of today's candle, more likely than not, that means the market needs to pull back, and at which point we'll see us kind of pull back and test the 20 period again and possibly come down to this 165 to 164 area. Now, one thing to keep in mind, it looks like we're at all-time highs if we look at this chart, but if we go back and drill out to the weekly, you'll see that there's still room for IWM to come up. So there's still a lot of catch-up that needs to be done here before the small caps and the Russell 2000 are trading in the same place as the other three indices. And I think that this is still a good area to look at as far as looking for long trades. I think there's still a lot of small caps that need to play catch-up. And if we have a market as strong as what we saw in 2017 or what we saw maybe in 2013, then the small caps are going to have to catch up, and they're going to have to make a pretty nice move to make it through and start printing new highs as well. And if that's the case, I think there's a lot of small cap names that could follow suit and could provide us with pretty nice moves. And that's one of the things that I've been watching is we're starting to see explosive moves again. Like I said last week, and again, I don't want to harp on my good trades just because they're good trades, but when a market starts to really explode upwards, you start to get more stuff like this. You start to get stuff like BYND that's just exploding upwards. And for those of you that maybe don't remember, this was my recommended trade from last Monday, right? So I put a blog post on it when it was here, and not that I expected a move of this volatility, but when you have the small caps start to make up for lost ground, when you see the market start to rally like we're seeing to start this year and to close the last year, you start to get more explosive stuff like this. You start to get more stuff like the other name that I reported that I wrote on that Monday was SHAK, and you can see SHAK starting to catch up today and start to making some big moves over the last couple of days. These types of moves, you see them more often during these types of bull markets. And so what we want to do is make sure that we are paying attention and trying to figure out where the strength is, where it's coming in, and make sure that we don't fall asleep at the wheel, because we're in a market right now that is, it could be very rewarding. The last couple of years, to go back to the S&P 500, and we're going to go to the weekly chart again. So the last couple of years were pretty difficult. A lot of traders struggled during these markets. Now, interestingly enough, even though the market was trading sideways, there were very clear trends. So it wasn't quite as difficult as it could have been. But we had a clear trend down, a clear trend up, a clear trend down, a clear trend up, and then we had some chop, right? But for the most part, these types of markets are much more difficult for traders because, of course, the market is going back and forth. When you have a market like what we saw in 2017, that kind of market really it erases a lot of mistakes that traders make and makes a lot of smart people. And so you want to go ahead and take advantage of a market that's like this. So another name, not a name that I traded, but another name that is indicative of what we're seeing in this type of market is Tesla. Take a look at what Tesla's done since basically November of last year. It went from 250 to basically 530, so basically doubled in price. And it just continues to ramp up and continues to hold well. And these are the kind of moves that you don't see when the market is chopping sideways. You see these kind of moves when we get these strong rallies. So now's the time that you want to take advantage and make sure that you are being diligent about the types of trades you're looking for, and you're not trying to short these, right? So again, how many people thought Tesla was overextended when it was trading in the 320s, and they tried to catch a short, and what? So look, let's say someone was perfect in catching this short from 350 to 350 or 360 to maybe 320, 330. They caught maybe 20 points, right? And they missed out on 200 points. It's like, it doesn't make sense right now to try to trade against the market or to try to fight it. You want to go ahead and take advantage of this upwards momentum, and make sure that you are taking advantage of what the market is giving you. All right, so that's my analysis of the markets. I don't want to preach too much, but I want to make sure that traders understand that the market is very strong, and at the moment it makes no sense to doubt it. If we get signs of a correction and we get signs of a top, then we'll know it, and then that's when we can go ahead and change. But for now, you don't want to just get nervous because the market is up. You want to go ahead and take advantage, and again, do so by trading names that are giving you good risk reward and giving you good opportunities. You don't necessarily need to chase the market upwards. Just because the market's up doesn't mean there are names that aren't providing you with opportunities. And I'll go over some of those in a little bit more detail after this if you guys want, depending on how many chart requests we get. Alright, so before we get to raise requests, or what he's mentioned on here, let's go ahead and take a look at the US dollar. One of Ray's trades is actually a US dollar Canadian trade, so we'll look at that. Anyone else that's in here, if you guys have a chart that you want me to look at, feel free to put it in. You never know, it could be the next Tesla or the next BYND. Let me know what you guys are looking at. I'd love to see it and see if we come up with some trade ideas together that could help us, again, profit in what could be a pretty strong market. So here's a look at the UUPNX. The US dollar starting to pull back a bit after I had this reactionary bounce. I think overall we've seen a pretty big change of character in the US dollar. from where it was at the end of last year to where we start now. I think there are a lot of signs of weakness, and there's the potential for the U.S. dollar to continue to drop. And I think now that we've kind of bounced and gotten our little, I don't want to call it a dead cat bounce, but we got a little reaction off of the bottom. I think there's a good chance that it turns right back down and starts heading lower. Maybe it doesn't come all the way down to 25.90, but at least half of that. So I think overall the U.S. dollar is starting to show a lot of chinks in the armor. And if we look at the euro-U.S. dollar cross, again, this one is inverse, so up is good for the euro and bad for the U.S. dollar. You can see very similar to UUP, just the mirror image of it. We had that U.S. dollar bounce as the euro pulled back, and now the euro found some support. You can see it's in a nice little incline here, and it probably wants to make its way back up to 111 to 112. 111.8 or whatever. It's at 111.5 right now. But you can see it found some support and wants to go higher, and I expect it to continue to climb higher until it gets to close to 112 and probably past it as it tries to reach the top of this channel. I think again the U.S. dollar or the euro has established a major bottom versus the U.S. dollar. In the long, it was weak against the U.S. dollar for a while. It's been really struggling, but I think it found a bottom. That doesn't mean it's going to make its way back up to the 120s, but I think at this point it's graduated towards being neutral and forming a base, and at that point it needs to kind of come up and explore what the top of that base is going to be, whether it's going to be around 112 or whether it's going to be around 114. I think at this point we got to give the euro the benefit of the doubt and assume that it's done dropping, and at this point wants to figure out what the top of this range is, and it looks like 109 or so is the bottom of it. So I think that this again bodes well for the euro and poorly for the U.S. dollar. And until we see a change in this and we see a break of this channel to the downside, we have to assume that the U.S. dollar will continue dropping versus the euro. Now, if we look at the U.S. versus the yen, we'll see a different picture. The U.S. dollar actually has had some strength against the yen, and I think in general this has been more indicative of yen weakness more than anything else. And there was a pretty big shift last week or the week before that, and it kind of reversed, and this was interesting because to me this is a major bottom. This is a very nice inverse head and shoulders, and we had the break above it, which was probably, it was looking to in my mind, to extend the price action upwards. So when you see this kind of pattern, I usually expect it to persist, and I expect that to turn into a very stable bottom that leads to higher price action. And in reality, the U.S. yen actually struggled a lot at this 109.5 area. And then we had this breakdown, which turned out to be a false breakdown. You can see a lot of volume coming in. You can see it coming right back up. And the U.S. dollar finally found its strength against the yen. And so if you're looking to trade the U.S. long, you probably want to look at it versus the yen. Now, again, it's a little extended here. It needs to kind of consolidate. But now we have a new level. What was resistance should be support. So as long as it holds above 109.5 or so, we should look at that as the area to buy and the area to go ahead and trade to the long once you see some support come in and you see the bull step up and support and defend that price zone. And then finally, we have the U.S. dollar Canadian, which Ray says that he's short. And this has been a pretty big change, too. The U.S. dollar has struggled a lot versus the Canadian. And, again, it had a little bit of a bounce, kind of reactionary bounce to forming new lows. And I would say that there's nothing wrong with trying to short this. Now, I will say that we're pretty close to a pretty decent level of support, but we started to dip below it the last couple of weeks, and now that we're back up here, we'll see. But if we do lose that level, I think that the bottom could really drop, and we could come all the way down to about 129. So Ray, if you're short this, I think that this is actually not a bad trade. You can see that we struggled a lot here at the 20-period moving average. We've got a big turn today, and so the key now is this enough to push the market back to 129? So, this looks like a potential bottom. And so what you want to see now, if you're trying to short this, is you want to see if the drop that's coming now takes us all the way back to 129, or whether we get a bounce somewhere in between that, somewhere around 120, 130 or so. And so that's kind of the key right now. Is we'll see whether there's support that comes in. But I think overall, when we look at the U.S. Canadian, when we look at what oil is doing, I think there's a very good chance that the U.S. dollar continues to struggle versus the Canadian, And if that's the case, then we'll see this drop a little bit further, and we'll see the Canadian pick up some more strength. If we look at oil, which is pretty inversely correlated to that, you can see oil. Oil actually had a pretty big drop, and I think that's kind of holding back the Canadian a bit. But if we get a bounce, which I anticipate coming in the near future on oil, that should help propel the Canadian dollar to pick up more ground versus the U.S. dollar. And as of right now, as far as oil is concerned, I think that oil sliced entirely through a channel which showed a lot of weakness. For those of you that were here last week, I expected it to break through the channel. And this is the point now where we want to see, these channels don't hold forever, right? So I think at this point, rather than continue to try to see whether oil can continue trading in this channel, what we want to see now is it went through, tried to accelerate. This is exactly what I was talking about also when we were looking at the S&P 500 and the NASDAQ, about an acceleration through a channel, right? A lot of times when you have a stock trading in a channel, and then all of a sudden you see it start to ride the very top. Once you have that explosion through it, that's usually a blow-off top. That's usually the last bullish excessiveness or exuberance before you get enough supply to kind of push it through, and then so you see you get the explosive move up, and then you get the really big rollover as the last people that tried to chase price action jump in, and then that's typically, not always, but a lot of times, the kind of the death of that channel, right? And so what we saw then was a break all the way through that channel and all the way through to the bottom. And so now what we want to see is, we want to see oil start to trade sideways, right? It had a very nice markup phase, or a nice bump up and a nice rally from 50, and it came up. Obviously it was overpriced once it started hitting into the mid 60s, right? 63, 64, 65 is way more than oil expects to be right now, or that we could sustain. So it pulled back, it dropped pretty quickly through and back through the bottom of that channel. And I think at this point what we want to see is, we want to see oil find support in the mid-50s and start to trade sideways and start to try to figure out what it wants to do next. Now, personally, I'd rather oil drops all the way to 50 and I keep getting cheaper gas prices, cheaper energy, but that's probably not going to happen. I think more likely than not what we're going to see now is we're going to see oil try to stabilize here and try to bounce. It will probably be a pretty mediocre bounce, and then from there, when it comes back and tests support, we'll see whether this ends up being a good level of support. Now, is there enough here for me to play a bounce yet? No, I don't think I've seen a reversal candle yet, but what I expect to see a reversal pattern in the near future, maybe as early as tomorrow, at which point we could look at it as maybe trying to bounce. And if it does bounce, I think that probably bodes well for the Canadian dollar to continue to push against the U.S., and maybe we see a further drop here. And see it come back down a little bit further. You're short from 130. Oh, from 130. Oh my! So you're not okay. Well, that's fine. That's yeah, that's fine. That's a good level to short. It's your fourth try though, which is a little scary. I'm not sure how you would have tried 4 times already, unless you tried every single one of those days. But I think overall, when you look at these wicks, right? If we just zoom in. You look at what's happening here, right? So you've got a lot of, so we had a nice bounce, and then you can see we lost most of that bounce with this pretty long wick, and then every time it's tried to get above the 20 or get to the 20, we've seen a lot of selling pressure and a close at the end of the day. And with today's move, not only did we see us try to push to the 20 and roll over, we're starting to we're starting to move down towards the lows, and we're losing a lot of, these dojis. At least you can see there was wicks on both sides showing that there was support and demand. At this point, there's not that much support, and we're starting to drop. And again, we'll see whether we pull. We should pull all the way back down to about 130, and then from there, we'll see whether we establish an upwards trend in the short term, or whether this is going to roll all the way over. One thing I will say, Ray, is make sure that you, if you get a decent amount of profit, at least take some off so that you're profitable. So you say you were too tight. You guess it could be that you were too tight. I think more likely than not it was because you were too early. And this is a mistake a lot of traders make. Is you see a level that you like. For instance, not that I think this is that important of a level, but I think if anything, if you really wanted to look at a level as an important level, it's this one, right? And I would assume that you didn't. I would assume that you were looking at maybe this. And so just to go into detail on your short and what happened here. Um, so this was really the key level. This was the level that was support that turned into resistance, right? So we came up, came down, trying to find support, failed, and then this candle was the rollover. And then we kind of came right back up, and we stalled out here 130. But you can see every time we tried to push upwards, that's when we started getting the selling pressure, right? So even though price action was coming up to 136.77, really the key price area was 135, and we were attempting to hold above it until today, right? So if someone wanted to short this, this is what they should have waited for. Was, you see the key price area, you see this little war zone here, and we'll use the rectangle for this. This is the war zone where they're fighting for price action, right? And we'll get this other trend line, and we'll use it for something else. Right? So today is really the day where it's worth shorting. Once we finally lost 135.30 and started rolling right back over, we lost the lows. This is this short-term trend line. It could be like this, or if it could even, you could have been like, well, we wanted to wait for this, right, for the break of yesterday's lows. But I would say more than anything, it's not that your stop was too tight; it's that you were too early, or well, yeah, you were too early. Really, it's what it comes down to, is that you weren't really analyzing it in the way, you weren't really looking at what the price action was doing, and this is really what you wanted to see. Was you wanted to see us try to break through this level. It failed, and then eventually today rolled right back over. So that was the key, is the fact that we finally capitulated today on trying to get through the 20 and trying to get above and hold above 130.05, which was the important level from before. And I think that's something that happens not just to you, it happens to everybody, it happens to me, is you identify a level that you want to trade, and when price gets to that level, you immediately want to get in, instead of waiting to make sure that the bulls or the bears. Anytime you have a major price level, there's going to be a fight between the bulls and the bears. And a lot of traders jump in early because they like that level. And they forget that despite the fact that you like that level, you still need to see who wins that fight between the two, because you're not the only one looking at that level. A lot of bears and a lot of bulls are both looking at the same level, because that's such an important level to break through. And you're going to have, at that point, that's where you have these battlegrounds, because you have bears that look at this level and say, well, this was support, it's supposed to be resistance now, I want to short here. But you have bulls that say, well, we broke down below that, but if we get back above this, then we're off to the races. So you have bulls waiting to try to push the action through here to get a rally going, and you have the bears trying to fight it. And that's when you have these wicks and you have these dojis, because you have two sides that are both trying to buy this, trying to take, or buy and sell this, trying to take advantage and trying to take control of the price action. And so in these scenarios, the best thing to do is identify the level, understand why it's an important level, and then wait to see who wins the fight, right? And then go ahead and react to it. And that's one of the key lessons that I always, that really improved my trading. And one of the things that I try to really stress is that we're when I always tell people, we're not in the business of predicting trades, we're in the business of following the price action. Doesn't mean you don't make predictions, but what you do is you make a prediction and then you wait for it to come true. And if it doesn't come true, you don't trade it. If it does come true, that's when you go ahead and trade it. So that's why a lot of times I'll wait until I make sure that I see who's winning that side. Now, I could still be wrong, or you could still, buyers could still step in and support this, and it bounces up the next day. But I think in this scenario, once you understand what level you're looking for, your odds of success are much higher if you would have waited for today rather than trying to get in yesterday, the day before, and the day before. Today is when it looks like the bears are finally starting to win out, and that's when you really want to get in. Now, if you're early, because you like the level and you're okay waiting for chop, then yeah, you need a wider stop, because you have to understand that there's going to be fluctuation as two different sides fight for the same thing. Okay? Alright, now, you also are long gold via JNUG, which you've been involved in for way too long. I would hope that you took some profits on this as it surged upwards. It would kill me, Ray, if you didn't take at least some partial profits when you finally got a strong move. Because you've been in this for a long time. I've explained to you the nature of triple leverage ETFs and why they eventually lose value. So when you have the strong moves, you need to take advantage, and you don't have to close out your whole trade if you really wanted to keep long, but you do want to take advantage when you can. Now, before we get to that, let's look at GLD and let's look at SLV. They both are actually in a very nice spot right now. We had the very explosive move. We had a pullback, and with today's candle, we're actually seeing a little bit of support, and this is actually not a bad time to go ahead and get long gold and silver if you like the names, or if you find a name that you like. Now, interestingly enough, they're doing a little bit better than GDX, which we'll get to in a second. But this is what happens a lot of times with gold: is you'll have these big moves, and then you have these like volatile flags that develop. And I think we found some good support here, 145.40. With today's bounce, we're a little bit above that. And if you take a look at it, you figure we've got another 2 points of upside, and we've got maybe a point of downside. It's okay to go ahead and try to play this right now if you like it. I think silver's doing something very similar. Risk reward maybe not the same. We're at 16.70, 20 cents, and no, yeah, it is. It's got about 40 cents of upside. So very similar case. Now, if we look at GDX, right, which is the gold miners, and we'll look at GDXJ next. You'll see something very similar, but you'll also notice their pullback was a little bit more substantial than what GLD is doing. However, it's also not in a bad place if you really want to go ahead and take a look at what GDX has done recently, right? So we're going to go ahead and put the major brush strokes here of what's happened. You can look at it that way. Actually, probably easier to look at it like this. We'll use the closing price of the breakout day, and so it's pretty clear what's happening here, right? We had an extended base. We broke out, kind of mediocre breakout, but then eventually enough momentum to push upwards. We start to falter up here at these previous highs around 29.80, close to 30. Came back and found support, and we're trying to bounce again, right? We're going to see the same story with GDXJ. So the same story, right? And it's the same story as GLD. So this is actually a good spot to be long. This is much better than what we were 2 weeks ago. And you went long GDXJ from 41.19. So again, you were early. You liked the level and you bought it. I'm assuming you bought it on this day. Or maybe you bought it there, I don't know, but I'm assuming you bought it here and you were early. And so it's the same thing. It's not about a price level. It's about finding the price action that supports the price level you like, right? And I think in this case, a case could be made for buying it today. I don't know. I mean, it's the same as GLD. You've got what do we got here? So from 41. We got about $1.50 of downside and about about $2 of upside. I think the risk reward's better on GLD than it is on GDXJ, but it is what it is, and I think that we're going to see a move back up to 42.50, 42.80. But I think gold is not in a bad spot here. We'll go ahead and take a look at KL, which is one of the ones we like to look at. This one had a pretty ugly drop. I'm not sure what was going on there. But I think it's doing all right. Give me 1 second. Sorry about that. So KL actually had a pretty ugly drop that I'm not that excited about. But it has made its way back up and is kind of coming right back up. And sometimes I like to look at this instead of the indices, the ETFs, because sometimes you get stronger moves out of this. And Kirkland Lake has been good, but in this particular case, I don't know that I'm there's still a gap to fill, and there's still a lot of resistance up here around 46. So I wouldn't trade this one right now, but I do like to look at it. It's one that you brought up, Ray, a long time ago, which I thought was a good stock, um, which has held up very well in the long term. As you can see, compared to most gold miners, this name has been very good. But in the short term, I'm still a little bit off. Still a little bit hesitant about trying to get back into it at this time. But yeah, so that's gold and silver, and Ray's trade on JNUG. Like I said, I like GLD. I like what I'm seeing here on GLD and SLV. And while most of us don't really want to trade these ETFs or the gold futures, I think they present nice opportunities right now. And some of the gold miners do if you go ahead and take through and find one you like, or just the gold miner ETFs. But just be careful if you do trade something like JNUG, because again, it's triple leverage, and if you don't get the quick bounce you're expecting, you could end up in a trade that decays over the long term against you. All right, let's take a look. Does anyone else have a stock they want to look at? I think I did. Ray, did you have anything else on here? I think that's all of them, right? TRLG. So you're in True Religion. No, wait. What is that? Oh, no, you're talking about your stop. Never mind. So, while I wait to see if anyone has a chart they want me to look at, so earlier I was discussing this idea of not wanting to chase the price action on the markets, but not, explaining how I still think there are good opportunities if you look for the right risk reward. So this was one of the trades that I mentioned on Monday in my Patreon blog post. One of the names I added to my watch list was TRP, and as you can see, it's up today. It's starting to move on us or move for us. It's not the greatest right now, but I don't want to use it as an example of a good trade. I want to use it as an example of what I mean by risk reward and what I mean by looking for stocks that are setting up for a move rather than chasing the price action higher in the market. So again, if you look at the S&P 500 right now, the risk reward is not great, right? This is not a good time to go long if you're trying to trade the price action. However, because of the strength in the market, we do want to trade long, right? So what we want to do is take advantage of the bullish environment we're in, but in names that are giving us better risk reward. So you go ahead and you take a look at this, and you've got a name that is giving you maybe 50 cents of downside, but is giving you about 2-3 points of upside, right? And at the very least, obviously it can push past 54 and continue upwards and continue extending outwards. But what you want to look at is you want to look at names that are giving you good risk reward that are not in the same place as the market. This is a stock that printed new highs and has pulled back and has consolidated and has found some support and is ready to start trying to make a new leg up in its overall rally, right? And so, that's an example of what I mean by you don't want to chase the price action higher, but you still want to trade in a bullish environment, is you want to find names that are either ahead or behind the curve, right? So this name already broke out and already pulled back. So even though the markets are breaking out, TRP already did and is pulled back and is waiting for the next move up and is starting to now. And again, look, 30 days before its next earnings, so I'm not worried about earnings right now. And with potential bounce coming in oil, this could end up giving us an even further bounce as it moves forward, right? So I think this is a good idea of what I'm explaining and what I'm trying to get at as far as trying to trade to the long side and trying to get good risk reward. Now, it doesn't always work in your favors. This is a name I recommended a few weeks ago and did not work. But again, if you look at the risk reward, this is exactly what you're looking for, right? You're looking for a name that gives you, 10 cents of downside and gives you about 40 or 50 cents of upside, 30 cents of upside, right? And it didn't work, but that's okay, because you know what? You stop out. You stop out right underneath it. In this particular case, the trade did trigger, so it's not like I didn't take it. But it triggered and then failed, and you just stop out. You lose your 10 cents, and you're done. But when you compare and contrast that to what ends up happening with other names like this, so we have one that stopped out on us, but then we have BYND that went nuts for us, or you have something like Amazon that, again, if you look at it when we traded it, we were looking for risk reward here. We're looking at this point at risk of maybe what was it? It was about 50 to 30, so about 20 points of downside, and more than 100 points of upside, right? Which ended up occurring. So you want to make sure that you're taking advantage of a market like this by finding stocks that are not necessarily at support, right? You don't have to buy value. Yeah, Beyond and Amazon were both stocks we bought at lows, but something like TRP, it's not really at lows. This is just a stock that's consolidating near highs. And you want to go ahead and try to structure your risk reward in a way like this so you could go ahead and take advantage of the upwards momentum in the market without chasing the price action. So I hope that helps. I hope that this gives you guys a better idea of what I mean when I'm saying that what types of trades I like to look at and why I'll say don't chase the price action in the market, but still say to go ahead and trade long, is because there are still names that you could trade long, despite the fact that the market's overextended. And this doesn't always happen. During the last couple of years when the market was extended and starting to pull back, a lot of names would pull back with it, and it would be a little bit of a different case. But until we see a change in character, the kind of market we're in right now tends to drift upwards. And if that's the case, we just have to take advantage of it by trying to find names that are giving us better risk reward, but continue to trade upwards and continue to take advantage of this upwards momentum. If you had a request that you didn't want to put publicly, you can always ask me, or if you didn't think of one now, but you think of one from here to next Wednesday, you can always message me on Twitter. You can find me on our Discord chat. You can email me, stockdarts@gmail, and I'll be more than happy to help you and give you my take on whatever chart you're looking at, or answer any questions you guys might have. Other than that, I hope you guys have a good rest of this week, and we'll meet again next Wednesday.